Happy Sunday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic updates in Europe, Asia, and North America. My name is Tony. Let's jump in. Now, we have a big episode for today. We have several major stories to move through from around the world, some pretty substantial and significant ones, so that we're on top of the developments as we move into a new week. And today we begin in Europe. London's Heathrow Airport faced its most severe disruption in over 2 decades after a fire at a nearby electrical substation caused a catastrophic power outage. The incident brought Europe's busiest airport to a standstill, affecting hundreds of thousands of passengers and leading to widespread flight cancellations and diversions. The fire, which broke out late Thursday night north of Heathrow, disrupted power supply to the airport and surrounding area. Authorities confirmed that the fire was under control by mid-morning on Friday, but the damage had already resulted in the cancellation or rerouting of over 1,300 flights. The financial impact of the incident is estimated between 80 and 100 million US dollars, considering costs related to passenger accommodations, rerouting and operational disruptions. The shutdown forced British Airways, Heathrow's largest airline, to cancel nearly 700 flights. Other major carriers, including Virgin Atlantic and Lufthansa, also faced significant disruptions. Flights bound for Heathrow were diverted to alternative airports such as Frankfurt and even further afield. The travel chaos is expected to persist for days. The UK Metropolitan Police's Counter-Terrorism Command is leading a probe into the incident, though there is no immediate evidence of foul play. However, the incident has raised serious questions about Heathrow's infrastructure and backup power systems. The effects of this unprecedented disruption are likely to ripple through global aviation networks, underscoring the need for improved resilience in major transport hubs. While Heathrow works to restore operations, travellers are advised to check with airlines before heading to the airport. Meanwhile, moving from one far edge of Europe to the other, Turkey's financial markets faced their worst turmoil in nearly 2 years this week, as an emergency interest rate hike failed to prevent a sharp depreciation of the lira, Turkey's currency, amid escalating political uncertainty. The Turkish lira extended its losses on Friday, trading 0.4% lower at 37.94 per dollar in Istanbul. The currency plunged 3.7% over the past 5 days, marking its steepest weekly drop since June 2023. Investor confidence was further rattled by the arrest of the Istanbul mayor, a key opposition figure, prompting widespread political and market turbulence. The Borsa Istanbul 100 index suffered a 7.8% drop, triggering circuit breakers and raising approximately 30 billion US dollars from the Turkish equity market. Banking stocks faced the brunt of the sell-off, with the BIST Banks Index down 26% for the week, the worst performance since at least 2001. Bond yields also soared, with the yield on 10-year government bonds rising 207 basis points to 33.38%. In a bid to stabilize the currency, Turkish lenders reportedly sold as much as 9 billion US dollars earlier in the week. The central bank delivered a surprise 200 basis point hike on Thursday, pushing overnight rates higher to curb capital outflows. Additionally, the bank announced a 91-day bill issuance set to start on Monday, aiming to absorb excess liquidity and tighten monetary conditions. The political unrest remains a major concern. Protests erupted following the political detention we discovered, and Turkey's opposition party has planned more demonstrations over the weekend. The president has warned against mass protests, heightening fears of further instability. Goldman Sachs and other analysts now anticipate the central bank will hold off on rate cuts at its next meeting on the 17th of April, a shift in expectations that has added pressure to Turkey's banking sector. The lira has completely collapsed in recent years, with its value versus the US dollar now down over 96% from its 2010 high and down 15% year over year. Now, for those who are curious, for the purposes of market update, Turkey and Russia will be considered part of Greater Europe, while the Middle East will be considered part of Asia. Australia and New Zealand, as countries in the Asia Pacific, will also be considered part of Asia. While some may take issue with some of this is simply for ease of categorization and should not be seen as a political or cultural statement. Now, with that said, let's now move to North America. US President Donald Trump has invoked emergency powers to enhance domestic production of critical minerals, aiming to reduce US dependence on foreign imports, particularly from China. Through an executive order signed Thursday, Trump has directed the use of the Defense Production Act to provide financial and logistical support for mineral extraction and processing in the United States. The initiative will involve the U.S. International Development Finance Corporation and the Department of Defense, which will facilitate funding, loans, and investment incentives for domestic mining projects. Additionally, the order accelerates permitting processes and instructs the Interior Department to prioritize mineral production on federal land. This move is in response to growing concerns over China's dominance in processing critical minerals essential for defense systems, batteries, and various high-technology industries. The White House emphasized that U.S. reliance on foreign minerals poses an economic and national security risk, as the country remains import-dependent on at least 15 critical minerals, with 70% of rare earth imports coming from China. Markets reacted sharply to the announcement. Shares of Australian lithium miner Liontown Resources Limited dropped 7.1%, while Sierra Resources Limited, a graphite producer, fell 9.8%. Chinese rare earths giant TNT Lithium Corp and Ganfeng Lithium also saw declines. Meanwhile, in the United States, MP Minerals Corp, a rare earths miner, rose 4.6% in after-hours trading, while coal producer Peabody Energy Corp gained over 2% after the announcement. The executive order extends to minerals such as uranium, copper, potash, and gold, with the potential inclusion of coal, a decision left to the National Energy Dominance Council. This aligns with broader efforts to secure a resilient domestic supply chain as China tightens export controls on key minerals like germanium and gallium. This is something that we have discussed in depth on my other channel, China Update. Industry groups, including the National Mining Association and SAFE, welcomed the move, citing its potential to strengthen national security and energy independence. However, environmental groups expressed concern, warning that the order may prioritize industry profits over ecological protections. The use of the DPA for mineral production is not unprecedented. Previous administrations, including President Joe Biden, leveraged the law to boost domestic battery metal production. Trump himself previously used the DPA to increase mass production during the COVID-19 pandemic. The policy marks a significant shift in U.S. mineral strategy as lawmakers continue to explore a national reserve to shield domestic producers from price volatility and geopolitical risks. As the global competition for critical minerals intensifies, the administration's directive signals a long-term commitment to securing America's mineral supply chains. Next up, we move to Asia, but just quickly, if you're getting some value from today's episode of Market Update, don't forget to hit the like button, and if you want to continue to be on top of the most up-to-date and consequential financial and economic updates from around the world, maybe consider subscribing, hit the bell notification icon, and you will be. Now, it has been a big week for Asia's second and the world's fourth largest economy, Japan. To end today, we will move through the salient developments in the land of the rising sun. This week, the Bank of Japan, Japan's central bank, opted to keep its benchmark interest rate unchanged at 0.5%, citing mounting global economic uncertainties, including trade tensions and U.S. policy shifts under U.S. President Donald Trump. The decision, made at the conclusion of a two-day policy board meeting this week, was widely anticipated by analysts and markets. In its statement, the Bank of Japan warned of high uncertainties surrounding economic activity and inflation, particularly in light of evolving trade policies worldwide. Bank of Japan Governor Kazuo Ueda emphasized that recent tariff developments in the United States had added complexity to Japan's economic outlook. While acknowledging that the full impact of these changes remains uncertain, Ueda stressed that April could provide more clarity on Washington's trade strategy. Japanese policymakers are particularly concerned about potential U.S. tariffs on Japanese exports, especially in the automotive sector, which we'll touch on shortly. Recent negotiations between Japan's Trade Minister Yojimoto and the U.S. Trade Representative Howard Lutnick failed to yield assurances on trade exemptions, intensifying fears of economic repercussions. Domestically, Japan faces a delicate balancing act as it seeks to normalize internal rates following decades of deflation and economic stagnation. While wages are rising, household finances are being squeezed by record-high rice prices and broader inflationary pressures. The Bank of Japan noted that headline inflation hit 4% year-on-year in January, reducing the real impact of recent pay increases. Japan's Shunto wage negotiations have resulted in significant pay hikes, with major firms such as Hitachi, Fujitsu, and Toshiba offering the biggest salary increases in over 25 years. The country's largest labor union, Ringo, secured an average wage increase of 5.46%, the highest in 33 years. After decades of stagnation, these developments will be a welcome sign. However, Moody's economists caution that inflation is eroding the benefits of these pay gains, estimating that real wages may take at least 2 more years to recover to pre-pandemic levels. Meanwhile, this week, we also learned that Japan's land prices rose at their fastest pace in 34 years in 2024, with gains spreading beyond major metropolitan areas into regional cities, signaling a broad recovery in the property market. A government survey released on Tuesday of this week showed that nationwide land prices, including residential and commercial areas, increased by 2.7% as of the 1st of January, marking the 4th consecutive year of growth. This represents the fastest pace of appreciation since 1991, before Japan's infamous asset bubble burst and sent land values into a prolonged decline. According to the Land Ministry, quote, Japan's overall land prices continued their rising trend amid a moderate economic recovery. End quote. A key driver of the surge has been the rebound in inbound tourism, which has boosted demand for hotels, retail spaces, and commercial properties. The ministry reported that land prices in 64% of surveyed plots now exceed pre-pandemic levels from 2020. Japan's major metropolitan areas, Tokyo, Osaka, and Nagoya, recorded a 4.3% increase in land prices, while regional cities such as Sapporo, Sendai, Hiroshima, and Fukuoka saw a 5.8% rise. However, growth in regional areas has begun to slow compared to 2023 as rising construction costs start to weigh on the market. Meanwhile, this week, Japan-based Nikkei Asia reports that Japan's 7 leading automakers, Toyota, Honda, Nissan, Subaru, Mazda, Mitsubishi, and Suzuki, are facing a sustained period of profit decline. For the October-December quarter, the combined operating profits of these automakers fell 25% year-on-year to $13.3 billion, marking the second consecutive quarterly drop. 5 of the 7 reported a decrease, with Toyota's profit falling 28%, while Nissan and Mitsubishi saw steep declines of 78% and 75% respectively. The drop in profitability is largely attributed to intensifying competition in the United States, where rising sales incentives are cutting into margins. By the end of 2024, US industry-wide incentives averaged nearly $4,000 per vehicle, a 50% surge from the previous year. Further compounding these challenges, tariffs proposed by US President Donald Trump could significantly increase costs. And finally, JX Advanced Metals saw a strong debut on the Tokyo Stock Exchange this week, closing 6.6% higher at the equivalent of $5.85 after raising $3 billion in Japan's biggest IPO in nearly 7 years. The Semiconductor Materials Group's listing tested investor appetite for chip-related stocks amid market volatility. The parent company, INEOS, Japan's largest oil refiner, retains a 42.4% stake, aiming to pivot towards low-carbon ventures. Despite initial skepticism, analysts suggest the tech stock downturn due to Trump's tariff threats could present a buying opportunity. JX Advanced Metals dominates the sputtering target market, crucial for semiconductor production, and is shifting focus to advanced materials. While its operating profit grew 18% last year, over 70% of earnings still come from traditional metals recycling. Analysts see the IPO as a test of investor discipline rather than a pure AI-driven play. So, in conclusion, Japanese policymakers face a delicate economic landscape to navigate, balancing wage growth, inflation management, a dynamic property sector, automaker pains, and trade uncertainties in an increasingly volatile global market. So, to those Japanese policymakers, ganbatte kudasai. Good luck. Okay, that is today's episode of Market Update. Thank you so much, everybody, for watching. Have a good Sunday, have a restful weekend, and I will see you tomorrow for a new week of updates.